Good morning. My name is Nisha Nancy Daniel, Faculty of Commerce and Management, Rama University, Kanpur. Today we are going to study financial accounting, and our topic for today is what is accounting, what are the types of accounts and their golden rules. So let's start with our session today. The first we need to understand what is accounting. Accounting is nothing but recording of a financial transaction. First you need to record the transactions, financial transactions. We need to understand, we need to only record financial transaction of our business or organization or entity. Next, after recording, you have to classify it. We have to post them into ledgers. So after that, after classifying, you have to summarize it. After summarizing, you have to maintain the income statements, balance sheets. So accounting is simply, we can say accounting is recording of financial transaction, classifying it and then summarizing it. Okay. Now we need to know what are the different kinds of accounts. We have three main accounts and three golden rules of accounting. These are the basics of financial accounting. If you don't know these golden rules, you cannot pass the journal entries or you cannot post ledger, you cannot do ledger postings. So let's understand the first account. Our first account is personal account. Personal account, as you can understand by the term personal, it is related to persons or firms or associations. It is related to individuals. And the golden rule for it, debit the receiver, credit the giver. In personal account, we debit our receiver and credit the giver. We will understand these rules with journal entries later, but let's first understand what are the different kinds of accounts. The next one is real account. Real account is those accounts which deals with all kinds of assets. It deals with all kinds of assets. It includes tangible assets also, and it also includes intangible assets. Tangible assets are those assets which can be seen, touched, felt. For example, our machinery, plant, cash. So these can be touched or they can be seen. It includes into tangible assets category. Next one is our intangible. Intangible assets are those which cannot be seen, so we cannot call them tangible. So they can be, for example, goodwill, patent. These are the examples of intangible assets. And the golden rules for real account is debit what comes in, credit what goes out. Whatever is coming in, we debit it, and whatever is going out, we credit it. Next is our last account is nominal account. Nominal account is related to our expenses, our losses, incomes and gains. We need to remember these four terms: expenses, losses, income and gains. So the rule for nominal account is debit all expenses and losses, credit all income and gains. We have to debit all our expenses and losses, and we have to credit all our incomes and gains. So to understand these kinds of accounts, we can take an example of some journal entries, some transactions, and we can understand how these accounting rules are used while passing our journal entries. So let's start with our first transaction. Mr. A commenced business with cash. Here Mr. A is starting his business with cash, rupees 1 lakh. So our first entry will be cash account debit to capital account. Now why we are debiting cash account? Now let's again turn to our rule. Cash is our asset, and we have just seen that real account deals with assets, and the rule is debit what comes in and credit what goes out. Here the cash is coming in. When you are starting a business, Mr. A is investing into the business, and cash is coming into the business. So cash is coming in, so debit what comes in. That is why we have debited cash here. Next we can see capital account is being credited. Why capital account is being credited? Again let's go to our rules. Capital account is personal account. Why it is personal account? Because it is saying Mr. A's account is being used for investing the business. Mr. A is starting the business with cash of rupees 1 lakh. So here Mr. A's capital account is being used. It's a personal account, and the rule for personal account is credit the giver. So that is why we have credited Mr. A's capital account, because the rules tell us that we have to credit the giver. So now let's look to the other transaction. A purchased goods for cash rupees 60,000. Here A is purchasing goods for rupees 60,000. Entry for it is purchase account debit to cash account. Okay. Now when we pass our entry for purchasing goods, we use the term purchases. It is the standard rule of accounting that we don't use the term goods, but we use the term purchases. Okay. Now we see that purchases is being debited here. Again we will move towards our rules. First we need to understand purchases deals with nominal account. Why? Because we have just gone through nominal account definition, which is said that nominal account is related to expenses, and when we are purchasing goods, this is our expense. We are doing some expense for the purpose of business, for production purpose in the business. So it is our expense, and the rule is debit all expenses. So that is why we have debited purchase account, because it is our expense. Next we have credited cash. Again cash is real account, and the rule is for real account is credit what goes out. While you are purchasing any good for the business, the cash is going out, because you are purchasing goods on the basis of cash. So our cash is going out of the business, and that is why we have credited cash, because the rule tells us we have to credit what goes out. So cash is going out of business, and we have credited cash over here. Next transaction is A paid salary to his employees rupees 20,000. Now we have we'll just see the entry, salary account debit to cash account. Why we have debited salary account here? Let's understand. Salary is our nominal account. Again we'll go to the definition. Nominal account is related to expenses and losses. So while we are giving salary to our employees, this is our expense of the business. This is the expense of the business, and that is why we have debited salary account, because the rule tells us debit all expenses. We are debiting all our expenses, and that is why we are debiting salary account over here. Next, to cash, again as we have seen in the above transaction, cash is our real account, and real account rule is credit what goes out. So here cash is going out when we are giving salaries to our employees. Our cash is going out of the business, and that is why we have credited cash over here. Next entry is A received interest in his bank account worth rupees 3,000. Now Mr. A has received some interest of rupees 3,000. Here we have seen that interest received account is being debited to bank account. Why interest account is being debited here? Again interest is our nominal account. Okay, interest is our nominal account, and to bank account. Bank account is our real account. So again we can understand the rules are being followed here. Next we can see purchase goods from Mr. B worth rupees 5,000. Some goods are being purchased on credit now. We need to see that there is no cash word used over here, and here the goods are being purchased from Mr. B on credit. We have not paid him the cash yet. So now we can see what entries is being passed. Purchase account debit to Mr. B. Again we will understand purchase account is being debited because it is our nominal account. It is the expense account. We will see that debit all expenses. So that is why we have debited purchase account over here. But why are we purchasing Mr. B and why not cash? So as I told you that it is not a cash transaction, but it is a transaction of credit, and Mr. B is our personal, and for personal we have seen the rule credit the giver. So Mr. B is giving Mr. B is giving the goods to Mr. A and we will credit Mr. B because he is the giver. In personal account, the rule is credit the giver, and that is why we are crediting Mr. B over here. Now, if we want to understand more of our rules, we can take one example like Mr. A sold goods to B, of rupees 5,000. So, what will be the entry for this? Mr. B account debit to sales account. Now, we have to see whenever we are selling something, we use the term sales, and we will again understand why Mr. B is being debited here and to sales is being credited. Mr. B is being debited here because the rules tell us in personal account debit the receiver. We have to debit the person or the firm or association who is receiving it. So, here Mr. B is receiving the goods, and that is why Mr. B is being debited over here. To sales account. Sales account is being credited because sales is our, it will show our nominal account, and we have to show our expenses and losses, and that is why we have credited over here. Okay, and if we want to take another example, we can say Mr. A sold goods for cash rupees 10,000. Okay, Mr. A sold goods for cash rupees 10,000. Here the entry will be cash account debit to sales account. Here the cash is coming in, that is why we have debited cash, debit what comes in, and we have credited sales because our goods are going out, and that is why we have credited it. So, this is all for today, and in our next lecture we will see our ledger posting. Thank you.